Stephan is the king of financial YouTube, and I actually enjoy his content. However, I recently saw a video where Graham was strongly against dividend stocks.
That I actually need to start investing more money in dividend stocks.
No, Dividend, don't do that. Don't do that.
Now, on this channel, we follow a dividend growth investing strategy, so it's safe to assume that I disagree with Graham here. Let's watch the rest of this clip, and then I'll be back to address each of his arguments.
Don't do that. Okay, I'm gonna tell you, Tiffany. Real talk here, okay? When you get dividends like that, the problem with dividends is that you're taxed on the money immediately. And in some cases, it's taxed as ordinary income, which especially for you in California, it's gonna be at your highest marginal tax bracket. That's not fun. On the other hand though, when you buy a stock and hold it over a year, you're gonna be taxed at long-term capital gains, which has a max of 20% plus, I think if you're making over $1 million a year, this is an extra like 3.8%. Point being, you're gonna be taxed significantly less by not getting dividends. And let's be real, even if you get like $2,000 a month from dividends, you don't need the extra money. It's not like you need that extra $2,000 a month to pay the bills. This is all extra that you're gonna be reinvesting. So my recommendation is don't get dividends. Do not do dividend stocks. You don't need the money. Instead, invest it in growth stocks long-term, hold it long-term, and maybe at some point you might be in a lower tax bracket in the future, at which case you'll end up paying anywhere from 0 to 20% tax. 0 if you're making under $40,000 a year, but for the bulk of it could really be like in the 15% tax bracket. That's a lot better than what you're paying right now. So no dividends at all. Long-term growth stocks, that's what I would do.
Yes, dividends are taxed. In fact, I just made a video where I fully explain how dividend taxes work in the United States. Graham's main point here is that by avoiding dividend stocks, you will only be taxed at the time of selling and pay a lower tax rate with long-term capital gains. I'll address both of these. He alludes to some dividends being taxed as ordinary income. This is mainly true for REITs, MLPs, and short-term holdings. However, if you own a dividend-paying stock for at least 60 days before the dividend execution date, then you will be federally taxed at the long-term capital gains rate. This means that if you're a long-term investor, the overwhelming majority of your dividends will be taxed at this lower rate. To be fair to Graham, the example of Tiffany from the video is the worst-case scenario. She's in the highest income bracket and lives in California, which has the worst state taxes. So for her long-term dividend stocks, she'd be federally taxed at 20%, plus the max California tax rate of 13%. Luckily, there are many states where you don't have to pay taxes on dividend income. Also, if you choose to invest in a Roth IRA, then you can actually avoid all taxes on dividend income and capital gains. The problem here is there's an annual contribution limit, and you can be disqualified from contributing if your income is too high. In the big picture, a dividend is just a distribution of profits by a corporation to its shareholders. So when a stock pays a dividend, it provides you income, but you still retain your full ownership in the company. This is one way you can receive cash flow without having to sell a stock. You don't have to sacrifice capital appreciation in this process either. There are many stocks who pay an above-average dividend that consistently grows while still seeing significant capital appreciation. So in the case of both growth stocks and dividend-paying stocks, you'd have the same long-term capital gains tax rate if you choose to sell it. Now, is the yearly tax on dividend income that bad? Well, I don't think so. Graham is getting hung up on dividend income being a taxable event. Let's reframe this. It seems beneficial to me to have additional income that's taxed at a lower rate than earned income. That's what a dividend is. I'd say it's the ideal form of income. Why would you turn down that dividend money? Let's go back to another point Graham made in the clip.
You don't need the extra money. It's not like you need that extra $2,000 a month to pay the bills. This is all extra that you're gonna be reinvesting.
This is all extra you're going to be reinvesting. Right, that's the whole point. Ideally, you want to reinvest all your dividend income so you can add to the long-term compounding. Your investments will generate income so that you can buy more shares, thus increasing your future income, allowing you to buy even more shares. This creates a snowball effect that can enhance the compounding of your investments. This reinvestment can be in the same company or a new company altogether. Then, when you retire, you could choose to take out some of your dividends to pay for expenses. Dividend growth investing is a great long-term strategy and it performs quite well. For example, the dividend aristocrats are stocks that have been consecutively increasing their dividend payments for over 25 years. From 2009 to 2019, the S&P 500 Dividend Aristocrats Index returned an annual average of 18.3%, compared with 17.1% for the S&P 500 as a whole. This is a comparison of total return, which assumes you reinvest dividends for both. The aristocrats have achieved their higher returns with less volatility than the full S&P. Since I watch Graham's channel, I know that when it comes to stocks, he primarily invests in the S&P 500. Well, that index does pay out a dividend, although small. However, a significant amount of the index's long-term total return is derived from its dividend. Since 1950, roughly 89% of its total return would have come from reinvesting dividends. This is because of the compounding effect I described earlier. It only gets stronger and stronger the longer you let it operate. I go into heavy detail on this topic in my video titled The Magic of Compounding. So, I disagree with Graham's thoughts on dividend stocks. However, I don't think he actually agrees with the harsh stance he took. I doubt he'd argue against investing in high-quality companies with an economic moat who consistently increase their earnings and dividend payments. I assume he was thinking more about risky high-yield stocks with unsustainable payments and a lack of capital appreciation. I like Graham. He generally gives great advice. I just disagreed with him on that point. With that said, dividend stocks are not the end-all be-all. There are plenty of great companies that don't pay dividends. Berkshire Hathaway, Amazon, Netflix, and Google are just some of the many examples. But avoiding a stock solely because they pay a dividend is silly. Thank you for watching Dividend Data. I'd greatly appreciate if you could leave a like and subscribe to the channel. If you follow me on Twitter, link in the description, you can get real-time updates of my buys and dividends coming in. Also, you can follow me on Instagram at Dividend Data. You can support the channel over on Patreon, where you can gain access to a community Discord server. The link is in the description. Please leave a comment below, and thank you for watching.